For anyone following the markets these days, you already know the more questions that we ask, the more questions that follow. It can certainly be a confusing time for investors, so we're going to break it all down for you right now on UBS Trending. All right, and welcome to UBS Trending, everybody. I'm Anthony Pastore. Thanks for being here. I'm really glad to be joined yet again by our good friend, Eddie Ghabour, co-founder and CEO of Key Advisors Wealth Management. Eddie, always a pleasure to have you here join us, and you always give us really good insights and just break it down for us. So let's start here with where we are with interest rates. Certainly, we are looking at this boom in yields on 2-year, 10-year, 30-year, but we still have so much cash on the sidelines. Investors are holding so much of this. What do you think this means? Why are investors holding all this cash? And since we're currently on the higher end of this, because I think rates are going to go higher, where are some of the opportunities that you're seeing out there?
So we actually have a very large cash position in short-term money markets, frankly, because it's been a first time in a long time, probably about 16 years since you've been getting paid a yield worth actually entertaining putting in your portfolio. And I think a lot of investors right now are still nervous in regards to potential recession here in the U.S. But I think the interest rate market really probably has investors spooked the most, because we've never seen an environment where you've seen interest rates rise this fast in this short a period of time. And with the amount of debt that we have on our corporate balance sheets, as well as families at home that have revolving lines of credit and things like that, their interest payments over the next 6 to 12 months are going to be a lot higher than what they were the past 6 to 12 months. So I think a lot of investors are okay being patient because interest rates aren't at zero. And I don't think rates are done going up. I think you're going to see, I tweeted this out a couple of weeks ago, I think you're going to see the 10-year go over 5%. Seemed crazy a couple of weeks ago, but now as we sit here, it might happen a lot sooner than even I anticipated. So the patience that people are going to have are going to allow them, in my opinion, where the big opportunity is going to be, is being able to put together portfolios that generate a really nice cash flow of dividend yields coming from corporate paper, potentially government paper, as well as yields on stocks that have really dropped. So I think the patience that we're going to have with our clients are going to afford us an opportunity that we haven't seen in over a decade, because this is the new normal of higher rates. I think the rates are where they should be, and investors need to be positioned for it.
Yeah, and it's interesting because we talk obviously a lot about what the Fed is doing and where the Fed is going, but you can't really ignore all of this economic data that we're seeing. It seems like the economy continues to expand. You have non-farm payroll for September coming in at 336,000, well above the 160,000 consensus. CPI has risen, it's fallen, but it's still above consensus every time that it is released, especially in September. Manufacturing is on the rise, retail sales are on the rise. What does the Fed have to do here, and what should they be doing, and what do you think they will do, especially as we have 2 more meetings from them before the year is over?
So look, the Feds are in a really tough spot now because they've really drawn that hard line on 2% inflation. And we just had CPI accelerate, we had PPI accelerate, retail sales expanded to a level that the market wasn't expecting. And GDP is probably going to be a hot number because a lot of government spending that we have seen the economy stay extremely resilient. So if they stick to what they say they're looking at, it probably means they're not done raising rates. I think the right thing to do is to wait and see how things play out. But I will say this, and this is probably not consensus, like a lot of my opinions at times, the bond market's not going to care what the Fed does. And if you notice, the 10-year is kind of ripped up even after the Fed paused last time. So I think the bond market is getting it right, where you're going to see rates go higher, whether the Fed stays where they are or raises. But based on what they've told us, if they stick to what they've told us, they should be raising one more time at least.
You think that'll happen on November 1st or December, or does it even matter at this point?
I don't really think it matters, because I think the interest rate market that investors need to follow are the bond market. Because I think it's probably consensus, and I would agree with this, that the Fed is only probably going to raise rates maybe one more time. Whether that's November, December, or next year, If I had to pick one right now, I would say they probably pause in November and maybe raise in December. But again, the bond market is what we're watching every single day because that's going to have a bigger impact on the economy. It's going to have a bigger impact on mortgage rates and the things that we look at to try to determine the next move we're going to have in this market.
Yeah. Well, I don't even know if this question is relevant anymore, the recession question, because when you look at a lot of the surveys, Bloomberg just recently did a survey of economists, and now there's a less than 50% chance across the board that we might hit a recession in the next 6 to 12 months. I wanted to ask your thoughts on that, given what we see. I mean, you look at the economic data, it's hard to even ignore that we're not still in an economic expansion. But of course, if the Fed keeps raising rates too much and it gets, and then that could tip us into the other side because things just get too expensive. So we'd just love to get your thoughts there, Eddie.
My concern right now is that we have another credit event like we had in March. If you look at when those banks failed and had those issues, it was part of it was because of the hit they took on their balance sheet with Treasury prices because of what happened with rates. Well, some of those Treasury prices are down double digits from where they were when it became an issue for those banks. So if you look at what happened coming into this year, it was probably close to 100% consensus that we were going to have a recession this year. And now I think that's flipped to your point, 50%. So I'll take the other side of that and say that we probably will have a recession because a lot of times the only thing, in my opinion, is going to bring inflation down. And the unfortunate reality is the solution to the problems we're having with inflation in this country, the only way you're going to get it down is demand destruction. And that demand destruction, unfortunately, comes in the form of a recession. So I think we're in for a mild recession next year, and we'll see how the market reacts to that. But the cost of capital relative to where it was a year ago, on a percentage basis, we've never seen anything like this before. So there's really no precedent for us to look back to try to guess what's going to happen. But I think it's simple math. We're going to have more bankruptcies on this business side and probably consumer side here over the next 12 months.
Yeah, you really put it perfectly there, Eddie. I think there's a lot that we don't know, and it's uncharted territory. So that's why certainly having conversations with you and other experts is really important in keeping people in the know. But before I let you go, really quickly, Eddie, obviously we look at equities, the S&P 500. It may have, tipped a little bit in the last couple of weeks, but it certainly has been on a tear from the beginning of the year till now. A lot of that led by technology. Do you think we can sustain that, or have we seen the best right now from the equity side of the market?
I think July is probably the peak that we saw here. And, it's going to be about earnings and interest rates, as well as the energy market and keeping an eye what happens there. So to me, we can't take the next leg higher until we get some stability in the bond market, because if we hit 5% on that 10-year Treasury, in my opinion, that's going to really spook the NASDAQ because of how sensitive they are to interest rates. And the problem we have is the Magnificent Seven carry one of the largest weightings we've seen any 7 stocks hold in any index on the S&P or in the NASDAQ. So if one of those 7 break because of interest rates or earnings, that's going to make the losses even harsher on the broader index because of how much they're weighted.
Eddie, thank you so much. It's always good to have you here. We'll get you back on soon. Thanks for joining us. Good to see you.
Thank you. Have a great day.
You too, Eddie. And for more information on anything we talked about from our Chief Investment Office or our partners, make sure to visit our Insights website at ubs.com/views and follow us on social media, everybody. We're on all the major channels, including Instagram. You can follow us at UBS Trending for all the studio's content that you're not going to find anywhere else. And if you have any questions about anything we spoke about today, reach out to your financial advisor. Until next time, I'm Anthony Pastore from New York City. Have a great rest of your day, and remember to keep your eyes on what's trending. See you soon, everybody.